Alphabet shares, as you see, up about 2.5%. This after reporting stronger than expected revenue growth. Its search and advertising businesses still showing solid gains, despite, of course, concerns that competition from the likes of ChatGPT and others is heating up. Joining us now is Youssef Squali, Truist Global Head of Internet and Media. Sticking with a buy rating, price target 200. You like the quarter, I assume. Point out any sort of key strength that kind of encouraged you, Youssef?
Hey, David. Thanks for having me on. So, yeah, you're right. We maintain the buy. We remain pretty positive on the name. Out of the quarter last night, there were a couple of things that stood out. One was the commercial queries. Management disclosed that they're actually seeing growth in commercial queries, which is really one of the key components of the model, and speaks to how different they are from ChatGPT, Perplexity, the others. The other is around the monetization of these queries. So there was a fear initially that these AI overviews ultimately will be monetizing at a lower rate than traditional search. And therefore, as those grow faster, it dilutes the model. That's not the case. What they also announced last night or disclosed that monetization of AI overviews is running at a similar rate than the monetization for the overall. So when you take those two together, I think that should really kind of put at ease, at least for now, this idea that Google is a net loser from the rise of AI. And if anything, we think they really remain at the bleeding edge of innovation there.
Yeah, I'm glad we made those points actually this morning as well. As you point out, AI overview monetizing at that same rate. Also, I was told about a 100 basis point beat on margin. Are they finally showing some cost discipline?
They have been showing actually pretty good improvements on the OpEx and just operational efficiencies. Although take that with a grain of salt, because as you know, they've dramatically increased their CapEx expectations, and as a result of the increased CapEx, there's just the way the P&L works or accounting works. There is an acceleration growth in depreciation of those capital expenditures, and that's going to seep eventually into margin. So the way we think about it, we actually think that while over the last several quarters we've seen improvement in margins, we may actually see a flattening or even a slight deceleration or deterioration in margin between now and the end of the year as they absorb that increased CapEx. But we think this is a temporary phenomenon. This is not at the beginning of a downward sloping trend in margins.
Finally, I made a point of mentioning Waymo because they mentioned it on the call in a way that I haven't heard, and Sundar even welcomed a question about it, talking even about personal ownership. I'm just curious as to how you view Waymo as a part of Google and whether you ever see it really adding value.
Well, the good news for now is we think Waymo has no implied value in Google's valuation or Alphabet's valuation. The last round, I think, was done around 40 to 50 billion, and that was when the company was really just commercialized in San Francisco. Fast forward the tape to today, they've already announced a half dozen markets. We think that over the next 12 to 18 months, they're going to be in dozens of markets. So as revenues grow, we think their unit economics improve, and we think the valuation would dramatically improve versus the last round. There is no reason in my mind that if Uber, which we also like, but if Uber is valued at 150, 160 billion, that Waymo shouldn't at least be worth that in time, not the end of the year, but over as they build out their infrastructure. So we think Waymo is actually one of the bright spots in the Google story right now, or in the Alphabet story.